Brilliant. Good afternoon. Thank you for joining us on the final session, the final panel. Thank you for a wonderful intro as well. Today we're going to be speaking about finding alpha in the digital asset markets, and I'm joined by a wonderful panel. There should be much for you to take away, much to obtain in terms of way of knowing how to navigate the markets and finding alpha there. So to begin with, I just want to get some sentiment analysis in the room. So can you put your hands up if you are currently bullish for the next 3 months of the market? I am. Okay, mixed. If you're neutral, put your hands up. Okay. And if you're bearish, put your hands up. Ooh. Lone survivor. You like it. We'll find out why afterwards. Okay, great. So as a brief introduction, so Jordan Walker, I'm head of business development at Re7 Capital. Re7 Capital is a digital asset firm. We run 2 funds, a DeFi yield fund, where we generate yield on chain by being a strategic liquidity provider to various protocols. We also have a second fund, which is a liquid token fund, where we hold a high conviction, high concentration basket of tokens that we conduct fundamental analysis on. And then we also have RE7 Labs, which is our on-chain part of the business, where we do strategic advisory for L1s and blockchains. On my left, we have...
Hi, I'm Sadie Raney. I'm the co-founder and CEO of Strix Leviathan. We're a quantitative hedge fund. I'm also the founder of Makara, which is an SEC-registered robo-advisor for crypto, which was acquired by Betterment out of New York a couple years ago. Strix Leviathan continues to operate, and it is a systematic quantitative hedge fund based in the US with an offshore feeder fund in the British Virgin Islands. Our main fund, as I mentioned, is systematic, but we also have DeFi strategies that we have layered into that fund.
Hi, I'm Colla. I'm head of alternatives funds and quant research at Seeds Bank. Seeds Bank is one of the leading private banks in Switzerland in the crypto space. We are a traditional family-run boutique private bank, but we offer crypto in, crypto out. We offer safe custody on our side. We also have a sister company that runs a fund of crypto hedge funds, which we've allocated to in most of our portfolios. That's a mostly market-neutral fund of hedge funds.
Yes, and my name is Keshian. I'm founder and CIO of Triton Liquid. Triton is a Abu Dhabi-based directional strategy, and we are actually incubating a quant strategy as well, which we will roll out over the next month. So ultimately, creating a multi-strat fund based in Abu Dhabi.
Hi, my name is Thijs. I would like to start by thanking the crowd for still being here. It's a beautiful day outside, so I hope that the crowd can find some alpha in this panel, what we are here for. VanEck is a traditional asset manager. It's family owned. The CEO currently is VanEck. We manage globally 100 billion assets under management, of which 2 billion is today in crypto. Of the 2 billion, most is in passive investments, so the Bitcoin ETF, the Ethereum ETF in the States, and then we have active funds, a hedge fund, a venture capital fund, an index fund. We also do some other stuff on-chain, and we're trying to be as crypto native as possible as a traditional asset manager. We were the first traditional asset manager to move on-chain, started from 2017. You may ask, why does traditional asset managers do anything with crypto? For us, it's betting on trends. VanEck has been around since 1955, and we are trying to see whatever trend is coming for investors to have some allocations to. I think one of the big examples when VanEck had the gold ETFs in a really early way for getting the investor to have exposure there. It was a long time ago, but right now we have the early exposure in crypto, and it's definitely beneficial for us today. For my daily operations, I'm mostly involved with the liquid token fund, which is a liquid token hedge fund based out of the Cayman entity.
Fantastic. So I'd like to start maybe at the top, kind of looking at the macro picture. We have, a number of different elements taking place globally. We've got liquidity coming back from M2 global supply. We have rate cuts that have taken place. How do we take all of this information and synthesize it into, a view to ultimately generate conviction and, hopefully alpha in the market? Chris, maybe we can begin with you.
Yeah, absolutely. So one component of our strategy is to segment the space into 24 different verticals. So these would be like DEXs, derivative DEXs, infrastructure, layer ones. What we do is we take all independent variables that may impact price for that specific vertical, and we create a regression model to try to determine what the most significant variables are that impact price for specific verticals. If you run this across all verticals, the most significant factors are all macro factors. It's all liquidity, it's all interest rates. And so I think that matters a lot and will continue to matter until crypto begins to sort of evolve past just being a macro hedge in some components.
Got it. And Thijs, maybe just kind of getting your opinion in terms of how you guys take your worldview of what happens in the markets to position yourselves.
Yeah, I would answer that for the liquid token fund. We do have 2 research analysts sitting in New York. I'm based out of Amsterdam, but on a daily basis, we are trying to touch every decentralized application. And by touching those applications, you can actually see how they work or whenever they have product market fit. So we try to bet on applications that can attract users in the future. We then think, okay, on what chains can these applications be built? So that are the smart contract layers, for example, Solana, Ethereum, Sui. We then come all together as a team, think about, hey, why does this founder or this team can produce product market fit products? We invite them for calls. We're trying to find all the fundamentals, what these founders do in the past, like did they build good product or not? And then we also have some systematic data because then you're going on chain, you can see, because of blockchain technology, everything is transparent. So you can have API keys to the blockchain, trying to find how many users are using a specific D app. For example, gaming. If you have a new game, you can, from day one, already see how many wallets interacted with the game. And that's alpha right there, right? So you can see there's maybe 10,000 people that actually interacted with the D app. And then you can invest early on by your analyst that already tried the game and already see that there's some traction in user metrics from a really early standpoint. If you compare that with traditional venture capital, that's not something you can do. So I think it's a mix of fundamental and systematic data that you can use in investing.
Yeah, and I think one of the most interesting things when it comes to crypto is now just the abundance of data. You have blockchains that are hosting so much data that wouldn't necessarily be accessible. You also have the element where markets are moving 24/7 as well. So you've got 2 extra days over a course of 10 or 15 years, which has increased the amount of data that is available, and you then have to index it. But Chris, maybe just coming back to you, you said you segment everything into 24 verticals. How do you sort of apply on-chain data and metrics into these verticals as well?
Yeah, so many of our independent variables that we put into those models and regress against price for each independent vertical, they are on-chain metrics. And what's really unique about this asset class is that these are basically early stage companies, right? They're a year old, sometimes 4 years old, but they are still fiercely competitive. Moats are low because you can effectively just fork someone's code and launch a competing protocol. So the competitive dynamics are quite fierce. And again, what we leverage is building dashboards that look at real-time user metrics, real-time retention, real-time revenue, how much of that accrues back to the base token. And we believe that ultimately, this will be the basis of capital allocation if this space truly evolves, right? Actually seeing real-time user numbers and how that value flows back to the token that the investors are ultimately holding. Yeah.
And if we look at maybe a source of alpha when we think around systematic versus fundamental, maybe Colla, we can get sort of your perspective here on the two different approaches to using this data and generating alpha.
Yeah, so I think we have the luxury of sitting in the seat of an asset allocator. We are very focused on systematics. We think the opportunity set within the crypto market of arbitrage strategies, whether it's basis arbitrage, cross-exchange arbitrage, even market-making opportunities, is much more interesting than in the traditional markets, where it's been completely taken over by the giants, which are either prop shops or the citadels and millenniums. So we feel there's so much uncorrelated value to be unlocked there that we don't really have a core interest in going down the fundamental way. Our clients, as I said earlier, because we offer the possibility of actually owning these tokens, we can play the directionality through the actual just plain vanilla token holding, and then add on top of that some uncorrelated returns that come from these systematic arbitrage strategies. So for us, it's purely systematic.
Got it. And Sadie, maybe your perspective as a quant manager.
Yeah, when it comes to fundamental versus systematic, I mean, they're both valid strategies and they're both ways to generate alpha, but it really comes down to what your investor base is looking for and then what your investment thesis is. And if you want to make a fundamental investment in any of these assets, they're so young and there's really no agreement what this fundamental analysis should really be in the long term for these assets. So a fundamental strategy is going to be a buy and hold or a long-term strategy, and you're going to have to white knuckle it during the big drawdowns and just know that you're going to have to ride out massive volatility. And if that's what you're okay with, and that's a good strategy. We are a systematic fund. We don't want to watch things fall off a cliff repeatedly. So what we're doing is we are actively managing our fund so that we're mitigating that downside, and then we're capturing as much upside as possible. And we've traded BTC from 3,000 to 60,000. We've seen a massive swing multiple times in the markets, and we've exited the markets and minimized the downside every time. And we believe that's the better way to go in the long term. But you could slice and dice the last 10 years of trading, and depending on the timeline that you picked, you could say one is actually better than the other. It just really depends on what your time frame is. But I think in the long term, systematic is definitely going to be the more profitable approach, which is why we're in the systematic space.
Got it. And maybe just to sort of hone in a little bit in terms of your investor base and the demand for systematic. Has there been questions around, would you consider a fundamental strategy given, you look at Bitcoin, you look at the returns, over the course of 10 years, being very, skewed to the upside? Is that a question that kind of comes up or something that, you would ever consider?
It does, but I think right now a lot of the people who are wanting to make fundamental bets really are still pretty cautious, and those fundamental bets are going to stay within the top 5 to 10. And there's a lot of products out there right now who meet that demand. So, then there's this other pocket where it's people who are wanting to make fundamental bets that are much more bets than anything on these illiquid and brand new tokens where there's no data. So we haven't offered any products that focus on the fundamentals. I think there's other funds out there that do that and do that well. So we prefer the quantitative approach, and that's what we've stuck to.
That's great. And maybe just sort of shifting gears a little bit, thinking about some of the market structures that have taken place with the birth of crypto. So now we have ETFs in market. which we've seen have performed excellently over the course of the year, particularly in Bitcoin, less so in Ethereum on a relative basis. We have the birth of DeFi, which again is a new existence that has come with the inception of crypto. Sadie, maybe coming to you again. When it comes to DeFi, you mentioned you're enabling some DeFi within your strategy. I recently read a report from AllianceBernstein, and it mentioned that with the 50 bips rate cut implemented by the Fed, DeFi will be a big beneficiary, given that there's higher yields to be obtained within the DeFi market. How are you thinking about DeFi within your strategy?
So it's impossible to think about DeFi without thinking about risk. And we were already in a high-risk asset class, and then you add in DeFi, which you just have risk coming at you from every direction when it comes to DeFi. So you can get higher returns and more sustainable returns until you can't, until your fund blows up, depending on what you're doing. So we evaluate risk pretty aggressively against the DeFi positions that we take. And, there's some safer things that you can do, like staking with, some of the more reputable platforms and custodians. But, when you get into market making for some brand new or highly illiquid coins, and you're working with counterparties that are difficult to diligence, the risk factor really increases. And so we have to be really careful about how much risk we're willing to take on to get those slightly higher returns. And when you do have investors that have other options to get 8% a year, and maybe some DeFi strategies are getting 13, does that extra risk really justify what that return difference is? And in some cases, yes. Some cases, no.
Chris, I saw you lean forward. Did you?
Yeah, so I'm currently circling heavily back to DeFi. We are as a fund. And just to make a more declarative statement, I think DeFi is wildly underowned and undervalued right now. And I think that if there is a regime change in the US, I think you see the Uniswap Wells notice disappear. I think you see clear skies for DeFi. And so that is an area that we are circling back to. And I think actually, if you're just to be super rigorous about cash flow, these are the projects that actually generate cash flow in crypto, right? Full stop. As a sector. So I'm becoming increasingly bullish DeFi.
Yeah. As at Re7, our fund began really at the inception of DeFi, and we see it is very interesting. We kind of think of it as a fixed income style portfolio, because really you're underwriting smart contracts risk in terms of, are you going to allocate or supply liquidity per smart contract? But with new sources of liquidity and yield coming on chain in the form of real world assets or tokenized treasuries, we think it represents a very interesting and big opportunity. And we're beginning to see some of the emergence of TradFi coming on chain or finding ways to explore. And I think regulation definitely plays an important part there. Thijs, maybe from the standpoint of VanEck trying to be as crypto native as possible when it comes to DeFi, how is it that you're approaching, exploring DeFi?
Yes, I mean, that's a good question. So first of all, we would love to touch liquidity, and we do see more and more liquidity on chain. The biggest problem is, however, counterparty risk, KYC. We don't know yet who the counterparty is. We have to wait for more permissioned DEXs that can actually tell us who is on the other side of the trades. We are looking more and more into it. So from a prop trading perspective, we do a little DeFi activities. So we're getting more familiar and more comfortable with using DeFi. And I would say in the next few years, yes, I do see VanEck also trading on Uniswap, for example. But right now, whenever we don't know who the counterparty is, it's not right for us to do any trading. And again, that is also up to the compliance, risk, and legal department within a big firm like us.
And maybe just touching upon sort of market structure. As of today, the market is fairly fragmented in terms of it's hard to have seamless liquidity. It's hard to be capital efficient, from trading on one DEX to maybe a centralized exchange to a prime broker. I guess maybe Colla, coming to you, when it comes to your setup, like how is it that you guys will sort of manage that sort of capital efficiency piece, and how does that sort of play into enabling you not to lose percentage points because you're not able to move capital around in an efficient manner?
So we work very closely with the managers we invest in. We're very aggressive on the terms we need in terms of liquidity. First and foremost, because we want to be able to reallocate dynamically. I think it's one of the largest issues there has been in the world of hedge funds, traditional hedge funds, that have such a long period of withdrawal. So we don't really have the same issues of capital efficiencies as the funds we invest in, but it is a key part of our due diligence and the way we look at it and the returns we want to deliver. It's key for us that each of these managers has a very strong setup and ensures that their cash is always put to work.
And Sadie, from your perspective?
From our perspective, liquidity is always a nightmare. It's for managers, especially in the United States, because of regulatory and compliance, trying to make sure that we can move money efficiently is extremely difficult. We don't want to put a concentrated risk on one counterparty, and so to spread across multiple counterparties, then you're going to get, especially in the US, you're going to get counterparties with lower liquidity and not necessarily higher security. So at times, we have to evaluate liquidity advantage versus potentially some more security risks and how we mitigate those. And so it's a constant battle. We've traded with OTC desks. We were trading on exchange, and you've got different settlement terms across different desks, and it's a whole side project that you have to manage when you're trying to deploy into the markets. And sometimes counterparties that are really solid and have great offerings, you just can't trade with them because you can't move funds in and out fast enough, and it just eats away at your returns.
Yeah, I think, prior to me being at Re7, I was at Fidelity, and one of the things that we were trying to solve for very significantly is really that off-exchange settlement piece and capital efficiency. We know that many funds have suffered over the course of the last 2 and a bit years with some obviously well-documented and profiled exchange collapses. And that's where I think we've also seen really one of the significant use cases of DeFi and exchanges, because of a level of transparency that is available there. And again, from assessing your counterparty as a smart contract purely, rather than I guess a level of opaqueness from a formal institution, is one of the ways in which we think we can see greater opportunity, which ultimately will lead to better alpha from a returns perspective, when you're able to have your capital more efficient and not lose percentage points. On the topic of liquidity, maybe Chris and Thijs, I can get your perspective on when you're looking at tokens that are maybe further down the spectrum, smaller in size, how is it that you approach liquidity, getting in and out of names? Some names can be very sensitive as well. What's the approach that you take?
Yeah, so obviously with most of the majors, highly liquid, you can get in and out pretty easily through any venue. But we play in the long tail of assets, which means that effectively we are running our fund strategy, but then we are running an execution strategy on top of that fund strategy, which is arguably as important. We use a bunch of different desks to do this, and we have a bunch of algorithms that we've built ourselves. We lean heavily into volume-weighted algorithms, which can get you in and out of positions as you see volume spikes. But the further out on the risk curve you move in the space, the more important this aspect becomes. I could liquidate 94% of my book in 24 hours, and then the rest would take like another 48 hours, which that level of liquidity is pretty nice, and investors like that.
I think it's the same for our liquid token fund. I think 94%, maybe 95, you can get out in a day. But the smaller allocations on the right two of the curve will take some time to get those out. But we are using the same approaches as Chris is doing, and that is with OTC desks that can trade the assets for us. One very important thing for us is we don't ever leave assets on exchanges. So at the end of the day, we are always having all assets in cold custody, so that the investor is not risking any of the assets on an exchange. For example, FTX, what happened 2 years ago. So we can ask the OTC desk to trade assets in a week, and we settle at the end of the week. And then the OTC desk move first, and we move second, also mitigating counterparty risk there.
And so last week, being in Singapore, it was very interesting to kind of see the sentiment of the market more broadly. And going to Solana Breakpoint, there were many interesting projects that had entered into the market and are building. Maybe coming back to yourselves, Chris and Thijs, when it comes to the overall market and you look at various sectors, what sectors are sort of most appealing to you? How are you thinking about, let's say, the next sort of 3 to 6 months, but then also on a 12 to 24-month basis when you look at the market?
Yes, it's funny that you start with Solana Breakpoint. I would say 2 verticals already touch Solana, that is payments and DePIN. We do heavily invest in those 2 verticals because we believe, first of all, payments is going to happen on chain. There's like one big product market fit that's already happening today, that's stablecoins. It's being used all over the world. And it's like, how much do they settle today? Like trillions a year. And I think that is only going to continue to grow over time. And you have companies like PayPal, Visa, MasterCard that all partner up with these chains. And Solana is being mentioned many times by these specific payment providers. So I think payments is a nice vertical. DePIN is a little bit more complex to understand, but it is more that you have these nodes. I'm going to give it a try. you have these nodes that they distribute to people that can earn tokens by having these nodes. A good example is a project called HiveMapper. You can buy these dash cams, you place it in front of your car, and you're filming surroundings, and the surroundings are being then mapped to one big. You have to compare it with Apple Maps or Google Maps, and you have a street view. And this street view data is then being sold to the big parties like Apple Maps or Google Maps. They are paying in US dollar, and with the US dollar, they will buy the tokens, and the tokens are being burned from the supply, creating scarcity, which is an interesting metric to explain to investors. So that's also what we were talking about earlier, like cash flows can be seen as a burn mechanism in the token supply. So I think those 2 verticals with Solana, there's one more. And that is, of course, tokenization, something that has been said all day, RWAs, going on-chain with our traditional financial markets. When I started at VanEck, there was also a vision for me. We will have in the future one portfolio on-chain where we can trade crypto assets, but also can trade traditional equities, can trade traditional bonds, and that is where I see the future is going. So that's also coming back to Sadie. Why a fundamental approach in that vision makes more sense than having a systematic approach by only betting on volatility.
Yeah, just to add to that, all those were great points. Yeah, so not a ton to add, but prediction markets, I've been wildly interested in this for a long time, and I think that they are just now having their breakout moment, which is exciting. And then again, DeFi. I think that is, again, one of the use cases that actually generates revenue that accrues to token holders. And then last one, Bitcoin DeFi. I think there is a large portion of Bitcoin holders who, if risk is low, would like to generate some sort of yield on their Bitcoin that is just sitting there idly.
And just to zoom in there a little bit, when it comes to staking and Bitcoin DeFi, Chris, maybe you can just elaborate a little bit about what some of those interesting innovations are. You make a really good point. In Bitcoin, you have circa $1 trillion that is sitting, within this asset that is idle and not necessarily earning a return. I'm sure many of you have maybe come from a traditional finance background whereby ultimately you want your dollars and your assets to sweat. So maybe, Chris, you can just talk a little bit more about Bitcoin DeFi.
Yeah, I think a lot of what we've seen in Ethereum and Solana will be replicated, but then there's going to be new stuff. Again, as you mentioned, it's the largest pool of idle capital sitting there in crypto, and I think it remains to be seen whether investors just want Bitcoin to sit there and they don't want to take any other smart contract risk for an additional 5% per year, or whether there will be a robust market that springs up around lending and DeFi and all these other things that we've experimented with in different ecosystems. I'm not quite sure where I stand on that yet. I think that a lot of people just want Bitcoin to sit there and are not willing to take the extra risk for 10%, 5% additional yield. But I'm not a whale, so.
Well, if I can just jump in there, I think it's something that you mentioned earlier, also talking about DeFi and the idea of pricing a bond somehow by getting yield. I think people get caught in this false narrative of pricing it the way we price fixed income. We're talking about hack risk or fraud risk. This is something that's priced by insurances, and insurances struggle a lot to price their objects. So I think it's a false idea that we can easily price. You're talking, should it be a 3%, 5%, 7%, 10%? What's the right price for you to put your Bitcoin at risk through a smart contract? And I think that's something that's still very inefficient, and we don't have a clear answer to that. And we'll see, as you say, time will tell how investors will act, but it's just something I really wanted to make clear that don't get confused and don't assume it's a default risk. You're not taking equity risk with the foundation. You're taking fraud or hack risk.
Yeah. And maybe, Sadie, just from your perspective, when it comes to sort of the areas of interest for you over the next sort of 6 months, 12 months, and 18 months, which area of the market takes interest for you?
From a fund perspective, I would say it's going to be layer ones. We tend to trade in the top 20 to 30, and for us it's liquidity and volume that we're looking at. So it's going to be the layer ones. We're always looking at what's coming in and what's new, and evaluating whether or not it would fit with our strategies. But anything new is probably not going to pass our diligence and our risk process. So we're always looking to see what's out there, but I don't see anything in the next year that's going to get too exotic and fun. But on a personal perspective, I mean, I love all the stuff that everyone on the panel has mentioned, because there's just so many really interesting and amazing things that are coming online. And, those are where personally in my PA, I'm making the fundamental bets, because, I really like what a project's doing. I really like the tokenomics behind it, or the use case that I'm seeing, or sometimes even just the team that's involved. So, I'm always looking out there. There's wild and crazy crypto tokenization projects and NFTs and privacy NFT related projects that are just fascinating. So to me, I'm making my fundamental bets in my PA and across the board. But for the fund, we'll be looking in the more vanilla layer ones.
Yeah, and I think that's one of the great things of this industry. There are every day something new that is coming up. And of course, as managers, it becomes important for us to sift through what is good and what is not good. Colla, maybe just a final piece on your perspective. When it comes to capital coming into this space, I'm sure you're speaking with a vast array of institutional investors and crypto native as well. Where do you see capital coming from, and how will you be allocating it?
Yeah, I think we've heard a lot today about people talking up the game, thinking how fantastic and institutionalized the space is. To some extent, it has evolved a lot, but we're really, really far away. I think people or at least us here that are crypto familiar, got super excited with the ETFs. There have been massive flows there, but when we see our solutions, we're getting family offices, we're getting high net worth individuals, we're getting ultra high net worth individuals interested. We're not seeing the pension funds. The pension funds come, they see the product, and they're going to say, this looks fantastic, but I don't trust it yet. Or how can I go to my board and tell I want to put this product in my pension fund? So I think there's still ways to go before we get to that actual adoption. And we all kind of got into this super excited mood around the ETFs. But I think there's still many legs more before we actually see the truly gargantuan institutional players walk into the space.
And just in the final sort of minutes, just some quick fire questions for you all. So Sadie, maybe starting with you, Solana or Ethereum?
Oh, Solana.
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 Yeah, Solana, that's our largest current position.
I would say Solana, but also Sui.
Okay. Bitcoin above 100K by the end of 24? Yes or no?
This is not investment advice, right?
Not investment advice.
I would love to see that. Do I think I'll see that? Probably not.
No.
Yes, and I think it's path dependent, right? Obviously, as all things are. But I think if Bitcoin breaks 100K this year, it's going to blow past that pretty aggressively.
Let me start by saying this is not financial advice again. But yeah, I would say yes, it's going above 100K. And why do I think that? Everything is lining up this year. You have the liquidity cycle, it's just starting to get up. You have the Bitcoin halving, you have the elections, you have the monetary policy. There's a great research that was out this year by the Uniswap and a university that looked at the impact of monetary policy on the Bitcoin price. And it was the best effect that the greatest impact was, of course, the monetary policy and not adoption. So I think if you look historically where we are today, the last 3 months of this year are going to be super good for Bitcoin, and 100K is on the minimum.
And just to add my 2 pence, I also agree. I think the environment that we have set up at the moment definitely provides a prime opportunity whereby we could see that. And of course, not investment advice. Hopefully, this has been a useful conversation for all of you. I hope that the takeaway has been, one, there is a lot that goes into deciding and managing funds as a whole. I hope that you feel like you can take some of that away, but I also hope that you also feel comfortable that that needs to be done professionally, because there is a lot that goes into it. And yeah, I'd love to thank the wonderful panel for your insights, and we'll be around for some questions at the end. Thank you.
Thank you.
Thank you.
Thank you.